Debt market update March 2023. FY23 was a challenging year for Indian as well as global fixed income markets. Amidst the synchronized tightening by major central banks including RBI and rising yields globally, Indian G-Sec yield curve shifted up, especially post the budget, as the announced government borrowings exceeded market expectations. The rise in yields was further aggravated with RBI announcing repo rate hike and CRR increase in an unscheduled meeting in May 2022. To curb volatility in INR and drain out liquidity, RBI sold USD during the year. The yields at the short end rose at a much faster pace than the yields at the long end, thus flattening the yield curve. The 10-year benchmark G-Sec ended the year 48 basis points higher at 7.31%, while 1-year G-Sec yield rose by 247 basis points. The corporate bond spreads over G-Sec widened, driven by sharp increase in bond supply, especially in second half of the year. Average interbank liquidity declined considerably during the year, driven by sale of foreign exchange by RBI and increase in currency in circulation. Further, robust credit growth vis-a-vis the deposit growth also resulted in lower interbank liquidity. FPIs turned net sellers in FY23 and sold debt worth $0.3 billion as compared to being net buyers of $2.2 billion in FY22. Credit markets were largely stable during the year. The credit spreads normalized as corporate bond supply picked up during the second half of the year. During the year, RBI raised policy rates by 250 basis points to 6.5% and also introduced standard deposit facility at a rate 25 basis points lower than repo rate. RBI in its recent decision in April 2023 has kept the rates unchanged at 6.5% while maintaining stance of focus on withdrawal of accommodation. Outlook: FY23 was the year which saw inflation and rate hikes at a pace which has not been since past 4 decades. Inflation became broad-based globally as the disruption in supply chain, resilient demand, rise in energy prices, higher input prices, etc., fed into consumer prices. Consequently, central banks raised rates at a rapid pace to curb the demand momentum and tighten financial conditions and appeared resolved to continue to raise rates till there is definite sign of inflation slowing. However, in March 2023, failure of few mid-sized US banks and distressed merger of a large Swiss bank has raised concerns over financial stability and its spillover impact on growth. Going forward, pace of rate hikes is expected to slow and uncertainty regarding the overall impact of banking turmoil is likely to keep central banks data dependent. Post the pandemic easing and widening of corridor between repo and reverse repo rate, the effective policy rate during most part of 2021 was 3.35% as against policy rate of 4%. Since April 2022, RBI shifted its focus to inflation from growth and introduced standard deposit facility at a rate 25 basis points lower than repo rate. This, along with rate hike of 250 basis points and drain out of liquidity, resulted in operating rate moving close to 6.5%, thus resulting in an effective tightening of 315 basis points. Post the recent pause, RBI is likely to remain data dependent and will continue monitoring impact of already done rate hikes and rise in financial stability risks in coming months. Going forward, several factors seem favorably placed for the fixed income markets. CPI has eased from the peak and is likely to ease further in view of softening momentum, lower input price pressure, and correction in international commodity prices. Further, growth is also likely to moderate, driven by slowdown in exports, fiscal impulse declining, and private consumption normalizing. While external sector is a risk, it is likely to improve sequentially as the net oil imports decline on back of lower oil prices. Further, easing of USD from the peak and adequate foreign exchange reserves should take pressure off INR to a large extent, although outlook on capital flows remains uncertain. On the fiscal side, Announced budgeted market borrowings for FY24 were in line with market expectations and alleviated concern on GSEC supply. Also, in our opinion, most major central banks, including RBI, seem to be close to end of rate hiking cycle. Moreover, in our view, the bar for future rate hikes is high and therefore an extended pause seems probable at this stage. All the aforesaid factors are likely to bode well for the fixed income outlook. Key risks to aforesaid view are elevated core CPI, resilient domestic growth, robust credit demand, and continued global monetary tightening. Heightened geopolitical risks, elevated oil prices, tight liquidity, and increase in issuance of state development loans in FY24 are other important factors which can keep the yields at elevated levels. On an overall basis, in our view, yields are likely to trade in a range with a downward bias. While we continue to recommend investments into short to medium duration debt funds, investors could consider higher allocation to longer duration funds in a staggered manner, in line with individual risk appetite. Mutual fund investments are subject to market risks. Read all scheme related documents carefully.